So back in 2007, so quite a long time ago, I remember going on a fundraising trip trying to educate investors about investing in infrastructure. At the time, what we talked about was how it's an alternative to other types of investing, including public markets or private equity, and it offers downside protection that some of the other asset classes do not. I think that stands true today. We've kind of lost sight because of the success of infrastructure that people start chasing returns more. But really, at the end of the day, infrastructure should be resilient, inflation protected, and really have a very low loss ratio. So hopefully we'll see those principles continue.
Our asset class is new, and for that reason, our definitions are not settled. With the help of the ongoing crisis, hopefully we will have some progress in our definitions. The way I define infrastructure is depending on the risk profile. On the core to core plus end, which where infrastructure supposed to be showing its resilience, its low correlations to the others, and of course its inflation protection, the important point is on the structure in terms of the capital structure. The debt, if you are approaching it from an equity perspective, the debt should be long-term, as long as possible, and on a fixed rate, so that the asset is protected from the capital market fluctuations. That is quite significant. That should be embedded, and it should be central in defining what core is in the infrastructure space. A corollary, a second point related to that is the difference between infrastructure equity and infrastructure debt. Infrastructure equity is truly a long-lived, long-duration asset class. Infrastructure debt can also be long duration, but by definition, it's smaller than infrastructure equity. And on the inflation protection side, equity has a huge advantage as the debt can be hedged, or some of the managers, at least the good ones, are focusing on the fixed rate debt rather than the nominal ones.
I think what investors should understand more about the infrastructure asset class is that it is evolved from 10, 20 years ago being simply just buying long contracted assets, whether it's a toll road or a bridge, and has now moved into similar to real estate, into a much more mature asset class where there are different funds, different strategies with different risk levels and different opportunities that they're seeing in strategies that they're pursuing. So it's now moved from kind of core and others core plus, and now that you're seeing a more proliferation of more value add focused infrastructure managers. And I think this is more a result of the market opportunity evolving more than kind of managers changing their strategies.
I think for investors, I talk about infrastructure the way we see it being that low volatility cornerstone of your portfolio. The investments that we put into our infra program, if the music stops, we're still going to get our money back. The downside is a weak and disappointing return, but it's still capital protection. And I think that is something we're seeing more and more popularity with the strategy in the United States. In the past, we've seen infra be more popular in Europe, Canada, Australia, less so in the US. I think for US investors, maybe in the past, they would have thought equity real estate can be that anchor of cornerstone of stability. And there's more questions over that. And I think more people are coming to infra as, well, that can be my cornerstone of stability while still offering very attractive low double-digit equity returns with low volatility. So I think that's how I would position it for people.
I think infrastructure comes back to ultimately the hard assets that you want to own at the end of the day. The question is, how do you get there? There's several ways to get there. You can buy them ready-made, or you develop them yourselves. We take a development approach to infrastructure, which obviously has slightly more risk, but also higher return. I think it then comes really down to the contractual structures that you have in place and the protections you put in place. So what is ultimately your downside? If your downside is still a solid number that you can live with, this is for me the key for it being an infrastructure asset class, rather than going by definitions. It ultimately comes back to contractual protections and the downside you are able to achieve.